Hi, welcome to another episode. So, as you can see from my topic today, you know what I want to talk about. So, recently, right, there's no denying that the interest rates are sky high when it comes to actually real estate purchase. And I'm sure many people are skeptical and holding back on their purchases due to this factor. So, today, I would like to tackle this topic and then truly understand the situation better for you guys out there. So first of all, right, I think it's important to understand how interest rate affect the economy as a whole. So interest rate have a significant impact on our economy. It is actually the cost of borrowing money that actually affects both people like you and I, individuals or businesses as well. And this in turn actually will affect the way we spend and invest. Okay, so for example, for consumer spending, okay, when interest rates are low, people will tend to spend more money because borrowing is cheaper. All right, and this increased spending can then boost also economic growth and allow more money to flow through the economy. And the other flip side is when interest rates are high, then of course borrowing becomes more expensive. This is the current situation we are in also. And this will discourage spending and slow down the economic growth. Okay. And yeah, interest rates also play an important role in controlling inflation. This we must understand that when interest rates are high, cost of borrowing money is expensive, and it actually slow down consumer spending, and this will in turn help inflation, prevent prices from shooting uh, uh, sky high. All right, and the other flip side is also the same. When interest rates are low, then borrowing is cheap, and this will stimulate spending and potentially lead to higher inflation. So let's take a look at the current situation. All right. Now, how we actually got here. All right. Uh, this situation of high interest rates actually started back when COVID hit. All right. The pandemic in January of 2020, 3 years back now. Okay. And during this COVID pandemic, it will have no doubt led to an economic downturn. And to prevent the situation from getting back to worse, the government had to step in with certain measures. And one of these measures is actually to lower the interest rates. Okay. Now, why do the government lower these interest rates during an economic downturn? Okay. So it is one of a monetary policy that the government can actually make use of and adjust the interest rate and money supply, increase the money supply to stimulate the economy, as I mentioned earlier, right? So during recession, the government lower interest rates, increase money supply, and this will encourage borrowing and spending. Okay. Now, all this started when COVID started. Okay. In fear of this pandemic leading to a very severe economic downturn, the government eased the interest rates and pump money into the system, okay, into the economy, I would say, sorry. And this is where we would say that there is a cheap supply of money coming in. All right. So this actually resulted, in fact, in 2021 end, which is 2 years, it actually resulted to a very, very high inflation rate. Okay, as you can see from my chart here. All right. So all this leads to high inflation. But what is inflation? So let's try to understand this term inflation. It's actually used to describe the increase, okay, in prices of goods and services over time. If you take a look at the uh, meaning of inflation, all right. So in other words, it means that the money you have today will not be worth as much in the future because prices have gone up. Okay. So the most common cause of inflation is actually the increase of the supply of money in relation to the supply of goods and services. Okay, so when you have more money and uh, an average supply of goods and services, so then what happened is that people have more money to spend, right? So this in turn leads to an increase in demand for the goods and services. And this increase in demand will naturally cause the price of the goods and services to go up. Okay, so this can happen when the central bank, in this case, we look at the Fed, okay, which is the Federal Reserve System of the United States. Later, I'll explain why I use the Fed and how this actually affects us in Singapore. Okay, so they print more money, and when there's too much money in circulation in relation to the goods and services available, then of course, the this will cause an inflation. Okay, this will cause an inflation. All right. So why are we concerned with the Fed, and actually how does it affect Singapore, us in Singapore? Okay, so between Singapore and the US, we actually have very close financial ties. So Singapore interest rates actually very closely reflective of the interest rates of the Federal Reserve. Okay, this means that when the Federal Reserve raises or lowers the interest rates, okay, raises or lowers the interest rates, the Singapore interest rates are likely to follow in the same direction as well. Okay, United States, as you know, is the world's largest economy, and Singapore is a major financial hub in Southeast Asia. And we also have a very highly developed and diversified economy. So as a result, both of our countries have significant trade and investment links with each other. And that is why I'm using Fed as an example. And in fact, they are the ones leading the way in controlling this monetary policy. Okay, so when we see that we have such a high inflation rate, right? What happens next is in March 2022, when we are just coming out of the pandemic, this is the point in time where the Fed will increase the interest rates. Okay, why do they increase the interest rate? It's because they do not want overinflation. All right. Besides the Fed's increasing interest rates, there are also a lot of external factors that happen over the course of the 2 years between 2022 and 2022. 2020 and 2022. One of the external factors is China, the zero COVID policy in China. Okay, now zero COVID policy is actually aimed at preventing the spread of COVID-19 within the country. But because this policy actually involved a lot of strict measures such as lockdown, travel restrictions as well, and a lot of mass testing to control the outbreaks. So this policy is actually successful in containing the virus in China, but it has also a significant impact on the country's economy and global inflation. So China, as you know, is a major manufacturing hub and exporter. So they play a crucial role in global supply chains. The strict measures, right, would mean that they have disrupted a lot of these supply chains in the world, causing a lot of shortages of raw materials and components in a lot of industries around the world. And this will definitely lead to higher prices for goods and services. All right. And therefore, contributing to this high inflation rate as well. The other factor is the Russia-Ukraine war. So, as we all know, Russia is a major exporter of natural gas to Europe, and the conflict between the two countries actually led to disruption to these gas supplies to the region in Europe, and this has led to an increase in energy prices around the world as well. So all these factors actually are factors that causes the high inflation rate. So what can the Fed do? They based on monetary policy alone, they can actually increase, they then will have to naturally increase the interest rates to control this inflation from getting out of hand. Okay, but in the long term wise, right, is this action of increasing and then just keep increasing interest rate, is it sustainable? Okay, if we look at the earlier part here, okay, it is definitely something which is not sustainable, because as we increase interest rates, right, we are making it harder and harder for businesses and individuals to borrow money. And when, say for example, a business, they because of high interest rates, they don't want to borrow money because of high interest rate, and this actually delay a lot of investment and expansion of their businesses. So once you delay expansion of a business, this also adversely affect the economy, okay, economic growth. And once there's no spending, individuals like you, people like you and me, we start to cut back on our spending because of the high inflation rate. Things are so expensive now, you know. And why are they so expensive? So we cut back on our spending, and because of this reason, right, this interest rate and increase of interest rate cannot be sustainable for a long period. It will be very damaging for economic growth. All right, and as you can see, the Feds have already started to ease off their monetary policy. Okay, we can take a look at this. In fact, at the end of 2022, Feds have actually started to peak, and they started to plan to reduce the interest rates. Okay, so what is the projection going forward? Okay, as you can see here, at a high of 5.1, this year definitely will still remain high, because the projection for 2023 is actually 5.1% interest rates. And a projection in 2024 will start to dip already. And then by 2025, you'll see that it's back down to 3.1, and thereafter it will taper off even lower than that. Okay. Now, how does interest rate affect property prices? I think this is the main question that we must understand also. After understanding how interest rates have gotten high over the past 2-3 years, why they have gotten so high, that part we have to understand. Now we need to understand going forward, and how does interest rate affect property prices. Okay, so in fact, with the increase of interest rates, I'm glad to report that property prices actually still continue moving up, as you can see here. So this orange line is actually the 3-month SORA, which is an indicator of interest rate, mortgage rates for mortgage loan. Okay, and this is the URA property price index, okay, PPI. As you can see, even when interest rates move up, even when interest rates dip, the property prices are steadily still moving up. Okay, and even when there's an increase, there is no drop in property price. All right, but property price and property demand is very different from each other. Okay, even though property price start to are still high, we need to know what does a lot of people think in terms of buying property. When interest rates are high, people tend to hold back. Okay, very naturally will tend to hold back. In even their loan, okay, the way of calculating their loan, which is TDSR for private property, the stress test has actually gone up. Okay, and when I talk about stress test, is for example, based on your income, we stress test using 4.5%, for example. In the past, of course, when interest rates are low, we will use a lower stress test. Okay, so the amount that they can loan will also be affected, and this will dampen their appetite as well to buy property. Okay, so prices and demand is different in this scenario. So as you can see, okay, property price index still increase when interest rates have moved up. All right. So let's do a calculation based on these projections going forward. Okay, if you buy a property today, all right, what is the kind of interest rates that you expect to pay going forward? Okay, this we are using a progressive payment model. Progressive means that you don't pay the because the property is not ready. Okay, this is a BUC, building under construction. Okay, a new property. So you don't pay the whole lump sum immediately. Well, if you did, based on 5.1%, you'll be repaying $6,000. And of course, if you were to buy a few years later, when the interest rate is lower, you'll be paying $5,200. So roughly about $1,200 difference in mortgage. So actually, if you think about 1,200 in difference, it's actually not a lot of difference. So will it hinder a lot of people just because of the higher interest rates at this point in time? I don't think 1,200 in relation to a possible capital gains in property will really affect too much. But based on the progressive payment schedule, as you can see here, the effect is even lesser, because the first year, based on a high interest rate, you're paying the least because the property is not ready. So based on progressive payment, you're paying only 443, and thereby slowly increasing over the years. And when it comes up to the time where you are paying 3.1%, then that's when you pay the full mortgage. Okay, so now we take a look at this. This is what I'm talking about, the demand. Okay, usually when people want to buy property, they are more keen to look at property when there's a fall in interest rate, when interest rate drop. So that's why we see that the surge, okay, property price still increases, but when is that surge? That surge happens usually when there is a drop. Okay, you see this point? When there's a drop in interest rate. Okay, see this point? When there's a drop, surge. When there's a drop, surge. So when is the best time to buy? Don't you agree with me that if we buy during a high interest rate environment, and if we sell during a point in time where the interest rate drops, we get to enjoy this surge in prices? So progressive payment is one way that we can see how we can better make use of the current situation, all right, rather than paying a full mortgage upfront immediately. Even though if we really have to, because not everybody can buy a new property and enjoy a progressive payment schedule. So will this difference in interest rate really affect us by a lot? Actually, if you buy the right property, I don't think these interest rates actually play very much difference, okay, in terms of price and your cost. And moreover, if you watch my previous video, and you will understand that Singapore, we go by amortization. So as we repay our loan, okay, our interest rate goes down and our principal goes up. All right. So that with that principle and with what I've shared today, I don't believe that interest rates, a high interest rate environment will actually affect us in terms of investing into property. We definitely have to be more careful when we invest, okay, and choosing the right property to invest in, because there are a couple of thousands of dollars of difference. Okay, and this difference to some people is still a lot. So we have to sit down and really go through the numbers. All right. But in general, what I hope to achieve today, I hope you understand the interest rates and the increase of interest rates affecting our current real estate market better. All right. So yes, thank you for joining me today, and I look forward to seeing you on our next episode. Thank you.